go.
Streaming from South Africa to the world. This is the Stonks Go Moon podcast. What just happened? We break it down so you don't have to.
Welcome everyone to the Stonks Go Moon podcast. My guest today, Scott Andrews, is from LCMS trader and ForexBriefcase, friend of the show, returning guest, and probably my favorite Aussie. Him and Simon Ree. Scott, how are you?
I'm well, and it's gone fast this year. I think back, it was like in March or so when we did the first one.
In April, and this is your third time back, and every time you have a new title, which means that Scott's stock is rising in the world. I like it.
Look, it's been a big year, but I'd like to think that last year was sort of a few steps backwards for me, and I like to think I'm about break even or maybe a bit more than what I was in 2019. So,
but that's what they say, my friend, is you have to pull the bow and arrow back for it to go forwards.
I like that. Yeah.
You can use it. Listen, let's pick up where we last left things. Asian construction sector, looking to me like a house of cards, real problems. Everyone at this stage know what Evergrande, what's happening there and stuff like that. What do you think it's like working in that company or like under that pressure? What do you think that's like?
Yeah, we did discuss this, and I've been looking up things and just trying to get some tidbits on exactly what's sort of going on, but it just looks like that they just continue the jawboning of, oh, we're going to make this, oh, we can't do this, but then they end up doing it, and it's a great deal of pressure probably on the company. And from my perspective, it looks like just with the adjustment in, I guess, Xi Jinping's philosophy on things, it's not so much capitalist focus now, it's more prosperity for everyone. So they'll probably try and squeeze as much as they can out of the CEO and the people that they were following the rules, but now there's that change in mindset where that's not really what they want anymore. They want people to sort of be a little bit more reserved. And I think they'll probably come in when they have to, once he's been seen to liquidate as much as he can, sort of thing.
Because that's a bet, right? And that's a bet that people like Goldman Sachs is taking as well. And I see the chatter, they've been quite vocal, which was strange because they're quite subdued, right? They don't really speak much. And then when they came out with a really bullish stance on China, I was like, okay, cool. So either one or two things here. They either have something to sell to their clients, which, I mean, that's what they do, or they know something that we don't. And like the bet is that the CCP will bail Evergrande out. But looking at the share price, currently it's down 20% again. We are, things are not looking good. And I saw this morning, like separate to Evergrande, there are two companies called Sunshine 100 China Holdings, which defaulted $179 million. And then as we are recording today, there's a company called Kaisa Group Holdings, which faces a $400 million bond maturity. And outside of Evergrande, it's the biggest ower of foreign bondholders with like debts of 12 billion. This is, I mean, if I just like warning signs. I honestly, people taking bets, and I can't, for the life of me, can't bring myself to do it.
Yeah, I wouldn't be longing China stock. So I agree. I think it's not gonna be a good thing in regards to how the stock price performs. So I don't see, and where's the bottom is a very good question. So I just think it's going to be a lot of uncertainty. So that's going to drive prices lower. And then when things start recovering is a good question. I don't think that's a good game to play, honestly.
No, I'm with you. If you can't see the bottom, right, then there's no use in getting involved. Rather catch the middle. I see the central bank did basically, free up some liquidity in trying to help, but will like I said, let's see where the bottom is. And when the charts show us, hey, here's a nice bottom support, then we'll catch the ride up. Moving on to our other topic, which we first, I think we talked about it on the first episode, is buy now, pay later, which Darren Lee from Revolut called a feature and not a product. And if you were trading on those stocks, it looks like he might have been right, because they got absolutely hammered in that broad market sell-off that we're seeing currently. Sezzle down 15%, Zip down 9%, Afterpay, Jack Dorsey's love child, down 4%. But here's the weird thing for me is Black Friday saw a 400% surge in buy now, pay later usage. So that's not reflecting in the stock price. That's weird.
That's right. Yeah. And you can see that, and that was a metric that they were referring to. And the thing is, especially with Zip as well, they love just the credit. They rely on more and more people coming in, and then they have to dilute the share price even more. And it's every time they do that, they bring out. There's a lot of releases that they do, a lot of announcements and things like that. And it's trying to, it's almost like you're trying to get distracted by it if you were a shareholder. And I'm sure a lot of people are holding bags that are, from the tens or so, or even a little bit higher, because it got to around 14 or so, or even a little bit more when it was full hysteria mode. So not a good situation. There's a gap in the 360s or 370s. I don't have the chart in front of me, but that could get closed, and then who knows from there. It just depends on the inflation read this Friday.
Is it a limit gap up?
It did a little while ago, and it's not closed it yet. So it's
interesting. Twitter has the same limit gap at 60. And a lot of stocks. So let's talk let's get a bit technical and talk about gaps, because I think gaps is something that people don't really understand. What is it in layman's terms? What is a gap? If we say there's a gap in the price chart, what is that?
So essentially it will, on the chart itself, let's say something closed at $10. There is trading that occurs in after hour markets, and if big positions are transacted, there are not other mechanisms to actually trade the stock besides obviously the standard brokerages. And what you'll see is that it can, gap up to a higher price or a lower price. So there's actual physical gap in the chart. And, typically what happens there is it's either immediately closed and people trade that, or for reasons the market doesn't want to close it, it'll just keep moving the opposite direction.
But generally, it does close, right? That's what we believe in technical analysis, is that gaps get closed. We don't know when it can be in the future, but then that's where you would use indicators and stuff that to show you where it will close. So it's interesting that across this broad market sell-off, we've seen those gaps. It's sort of like a lot of liquidity leaving at all at once, and it's not when it has to go now. It can go much later and fill that price gap.
Yeah, exactly. That's right. And we're seeing a bit of a flight now to safety, which is how long is that?
Where is safety? Where is safety now?
I guess it just looks like it's not in the information technology sector. It's in the US, and it's dynamic, but it's.
Well, I mean, that's one of the beauties of, like Simon says, being a trader, right? Is being able to go both ways, the click of a mouse button. But there's a lot of people that's come in this year. I spoke to someone the other day. They said they saw a 3-fold increase in the amount of retail traders just on their platform. It was a South African banking institution, so not even like a retail broker and something. And I'm like, that is insane. But as we know, like trading has a very steep learning curve. People coming and saying, well, I'm going to quit my job, I'm going to do this, I'm going to figure it out in 2 to 4 weeks. And then they find maybe that, they make some money and then they lose everything and then they leave it all together. But what are some of the other alternatives in this trading / or retail trading investment space that people can look at if they don't want to trade for themselves?
Look, and I think we've seen that recently as well, because people are a little more open-minded, and especially for people who have tried themselves, we've seen a lot of people come into the market and probably got a bit of a reality check. And there's a lot of outlets that are present, either in the Forex market, in cryptocurrency. I see there's individuals or, companies that will allow you to sort of invest, into them, and they'll trade on your behalf. There's trading bots as well, which are, obviously hit and miss a little bit. There's, trade ideas, signals that are shared. So
talk to me about that first one, that managed accounts. Compared to, let's say, putting money into an ETF, right? Because that's sort of the popular one to go. How does putting money into a managed account differ from putting money into an ETF?
I would say with that, you would be in the market less of the time. So especially if it's an actively managed arrangement, then I would say that could be a little bit more flexible than the ETF option, which still does have management fees and the like. But you would just, and I guess a good managed account would endeavor to really beat, for example, the S&P, or in Australia, it would be the ASX 200, like around 10% a year. They would be looking, a good operator would be trying to 20% a year.
Let's talk about that, because what people don't realize is that you need to beat inflation, and you need to beat your money, needs to beat inflation, and your money needs to beat real inflation, not what the Federal Reserve states in, their inflation target might be like 4%, whatever. We know the real world inflation closer to maybe 12%. So I use just like I times it by 3. So if your investment isn't beating like 12%, then you're not really actually making money. And then when you deduce fees and everything, then you're actually going backwards. So that's interesting that 20% is actually what you should be targeting.
Yeah. And that's a good point about the real, when people think about having, usually there's a lot of money that are in savings still in Australia. And it's something that you really think about it from that perspective. It's money that's, losing its value as well.
Yeah, we see that in Africa as well. A lot of savings accounts offering people 4%, 5%, 6%, and they talk about growth, and they talk about investing, and they talk about, it's your money is safe. But ultimately, I believe it boils down to education and educating those people that there is a better way of doing it. Hence, these conversations that we're having with this podcast. Scott, thank you so much for coming on today. If the listeners want to link up with you, if they want to follow you, where can they do that? And just drop us on some socials.
So look, first point of call would be LinkedIn, just under Scott Andrews, or feel free to email me as well, scottandrews@forexbriefcase.com. And the YouTube channel as well, the LCMS Traders YouTube channel can be found, Jindal Thai. But the LinkedIn you see is where I post most frequently, under Scott Andrews.
Yeah, and go connect. And he is an absolutely amazing follow, probably the best Australian that you can follow. I love you all. Scott, thank you so much for joining us. To our listeners, peace, love, and prosperity. And we'll catch you in the next one. Cheers.